Hello, everyone. Welcome to this week's study session. Let's start off by taking a look at the risk model as we do each week. So we're on a sell alert. Of course, buy signal was on November 9th, and then we went on a sell alert on December 29th. And again, we're still on a buy signal, but sell alert means that you want to be a little cautious here, and it just means that we're closer to a sell signal, meaning that two uh, of the components went non-positive. Of course, we have up, down, volume, neutral, and we moved stock participation down to neutral. Taking a look at the long-term trend, still, or the long-term trend model, I should say, still on a solid buy signal. And again, we're up almost 30% since that buy signal. Of course, we recommended getting into the market even lower than that, with 50% of your long-term 401k money. I know a lot of you ask if I have long-term money. I do not. I do have a 401k, but I keep it basically in cash, fixed income, and all my trading is just swing and short-term trading. Um, I probably haven't had long-term capital gains in quite some time, so my tax rate sucks, if you will. But anyway, I'd rather pay a lot of taxes on gains than give it back and not pay taxes, of course. Let's take a look here. The advanced decline line, of course, is hitting new highs. That's a good sign. Breadth has been solid, and that's an indication that the market has more to go. But again, we still want to be cautious here because we've had that sentiment bumping against pretty high levels. We moderated for a couple weeks here now, and it doesn't mean we can't go higher, but it certainly means that there's a lot of people bullish, and the market has come a long way. So you definitely want to have one foot by the door, as I've been saying. And I think it's just made trading very difficult when there's this much bullishness and you've come a long way. It gets late stage, or at least maybe intermediate term stage in the bigger sense, and you start getting a lot of noise, a lot of retail buying in there, and a lack of institutions stepping to the plate could lead to the kind of volatility that we've seen around breakouts, and you know the drill. What's happened recently has been difficult. 2020 returns. Nasdaq, of course, was the star, up 43.6%. Russell 2000 up 18.4. S&P a little behind the Russell by 16.3, and the Dow, of course, the laggard, up only about 7% for the year for 2020. Going forward, if you take a look at the cycle work, I would never trade stocks based on this, but it's interesting just to take a look at the cycle work and what it forecasts going forward. You can see the first half of the year is supposed to be, fairly good, and then the second half of the year we get a decline going into, I guess, August, September. The exact fluctuation of this really isn't important. When you look at cycle work, you want to just look at the trend over a period. So you can see the general trend is up in the first half, down down in the second half, or at least in the third quarter or so, and in the fourth quarter being quite volatile. Um, so risk model is on a buy, but it's on sell alert. And I'm not seeing a whole lot of stock setups. This is sort of interesting where we went from difficult period, not many stock setups, and a whole bunch of stocks I saw set up a week ago. And I was getting pretty excited. I said, okay, well, this looks like maybe we're going to have a nice run into the end of the year here. And a lot of them didn't work, and we saw volatility around those pivot points, and now that list has contracted quite a bit. So I don't like that when you see a bunch of names and then it can't back itself up with a proliferation of breakouts working, and then more stocks setting up and keeping that list favorable. Now, the list isn't very small this week, but I feel like I'm starting to stretch here for names. So, again, we've seen a lot of air pockets. The thin names, the low price names, and some of the larger names too. It's been difficult pretty much across the board, unless you've been in the very very selective spots maybe that have worked. It is a selective market. I think you have to be selective because of that. Low risk entries, progressive exposure is extremely important. I want to talk about real quick the most frequent and costly mistakes that most traders make. And this is what you want to start this new year. Take a look at what happened in 2020, and if things went really well, great. Take a look at your strengths and build on them, and even improve your weaknesses still, and try to go for even a better year. But if you've had trouble, you want to go and really take a look at what's causing that trouble. And usually it's within this list right here is usually the things that cause the most trouble for traders. And I find that they're doing they're doing most frequently and it's most costly. So the first is succumbing to FOMO, fear of missing out. That's by chasing stocks up too far by the buy point, too far past the buy point, forcing trades and questionable setups, trading stocks that probably you shouldn't even be trading in the first place. Sometimes in hindsight, it's clearer. That's why you want to do post analysis. But chasing stocks up and like I said, if the stock gets away from you, let it go. It's better to let it go than to pay up too much and then get yourself at a loss. So you have to develop that patience. I don't know, people ask, how do you develop that patience? Well, after getting, burned enough times, I decided that it wasn't profitable. So I had to, develop that patience or I was going to lose money. So you just look at the results. Not cutting your losses short. I hope that there's nobody doing this, but or not, abiding by this rule. But I know there are some that are going to hold those losses, and if it works out for you and the stock turns around and goes up, God help you because you're getting rewarded for bad for bad behavior, and eventually it's going to cost you a lot of money. Not nailing down decent profits when you have them. Now this is where, when you have the profits, again, you can Monday morning quarterback. You sell a stock, goes higher. Gee, I should have held it. You hold the stock, and it goes lower. Gee, I should have sold it. Well, it's not about that. You're always going to be looking back and seeing that you should have maybe done something else in hindsight, but the result doesn't justify the means. So again, you have to have a plan. Are you a swing trader? Are you a long term? Or maybe, you're going for a big move on this stock and you've already made a decision. I'm going to go through some pullbacks. You need to have that plan. But I find that if you're swing trading, you have to nail down profits when you have them and nail them into strength and get out while the getting's good, because once they break and they come back in, they give back too much too fast and you give up too much of the profit and now it doesn't pay for itself. You're not paying for the risk. So not nailing down those profits, or worse, giving back a decent profit. You're up 20, 25%, and you let the stock come all the way back and either stop you out at break even or worse at a loss when you're at a big gain. That's even a much worse. That's the cardinal sin, I call it, giving back all of a decent profit. The other is not protecting your break even point once you attain a decent profit, and that doesn't mean that you move your stop up to break even the minute the stock goes up 3%. Then you're going to choke it off. But once the stock's up maybe 12, 15%, it's gone through a natural reaction back into new high ground. Yes, now you've got to start thinking about protecting your break even, or at least maybe having your stop and bringing your stop up. All right. If it was 8%, bring it to 4. Maybe look for a key low, reversal that's a trigger that it shouldn't be trading below, and maybe that's a tighter stop than what you originally had. This one here, the next one, is really one of the ones that I think is the most misunderstood, most underused, and is the most important. Pretty much, was cutting losses and progressive exposure are, I think, the two most important ways to minimize your drawdowns and to protect yourself from a large loss. And progressive exposure is very simple. It's just moving in progressively, incrementally, by not just jumping in and out. Or even if you do jump in, and maybe you jump into a big position, but it's one position. You take one 25% position, so you still only have 25% exposure. But if you're not, if things aren't working at 25%, why go to 50? If they're not working at 50, why go to 75 or 100? There's no reason. Wait till what your positions are working. So jumping in too fast, all at once instead of moving in incrementally, and then trading too large. Trading too large. A lot of people, I appear on Twitter. Oh, I got forced out of this stock, and it was so much pressure. And I look at the stock moved 2%. Well, if there's too much pressure with a 2% move, you're trading too large. I guarantee you're trading too large. So we call it the pillow factor, or sell down to the sleeping point, where you want to be trading where, you're not up all night worrying about your positions that if they gap down, you're going to have a gaping hole in your account. So you need to position size accordingly to your own risk tolerance. And then trying to recoup, this is something that people very often get caught into, where they get into a losing streak and then they start trading larger and trying to recoup that lost ground fast. They can't bear the fact that they lost and now they want to get it back. So they revenge trade. The worst thing you can do, because now you're starting to throw, good money after bad. And if you happen to be going into a correction that you don't know yet, stocks are stopping you out and it's about to get bad, and you start doing this, you're going to get yourself in a lot of trouble. And this is basically maybe a cousin of averaging down. Um, Averaging down is the worst possible thing that you can do, adding more to a losing position. This isn't building a position. If you're building a position, you're buying a quarter and then it maybe, pulls back 1% or 2 and you buy your next quarter position or half position. That's building a position. That's pyramiding. That's not averaging down. Averaging down is when you're in a stock, it comes down, it hits your stop, or puts you on a lot of pressure, and now you double up, because now if it moves back up, you get your money back faster, and you start doubling up on the stock. That's the worst thing you can do. I hope that nobody in my group is doing that. These are the most common mistakes. They're very costly. And every single one of these mistakes stems from one thing and one thing only, and that's not thinking risk first, not respecting risk. So go over this, make notes, and take a look at your own trading, see what's going on, and troubleshoot. This is where you're going to find most of those problems. Okay. Um, let's take a look here. So, as far as the stocks are concerned, I'm going to go through the buy alert list for the most part, not every stock, but the stocks and I'm going to go through them in order of what I think are the setups that may be actionable, or acting the best, and then kind of move down to more questionable and maybe ones that need more time. This Alcoa, really, again, I was probably trying to get in there a bit early, but just in case it took off, ran up this right side, got a little shakeout here. Now, this is a perfect example of sticking to your stop, especially, if the stock's off and you're 10 cents away from your stop. There's no sense in selling it. Just let it stop you out with that additional 10 cents. In this particular instance, it was 5 cents. So it held by a nickel. And again, the low here, right here, was 21.15. The stop was at 21.10. So it did not trigger, then had a good close, and now is acting pretty good. I mean, I would love to see it tighten up, go tight here and go inside and then break out from there. And that would set it up really, really, solid. But again, it might just go, but we already have this as an open position. AMD is another one where, you know, we of course have trimmed back on AMD and sold the position, but again, this may reset here. This may reset. It came in here, had a little shakeout, and now just moving sideways, building a handle basically in this big BCP coupled handle, if you will. You might get a little cheat area here within the handle to buy. We'll watch that and see how that acts. ANF is one that it's kind of questionable. It's an early turn. You can see it just started to turn to an uptrend. This is a stock that value buyers were buying years and years ago. The value buyers have been buying this stock for eternity. I don't know if they gave up on it yet, but it's finally starting to perk up a bit here. You've got a low cheat here, and again, if you get this right, you're getting it early in the turn. So this is one that's a potential. Um, FLXS is acting pretty good. Again, it came out a little V-shaped here and just moving sideways here, forming just a natural reaction. You might get a breakout to new highs here. I should point out that I have to say, I think the list is a scant list, and I also think the list is of lower quality. I don't see a really high quality buy alert list here, and so I'm a little concerned about that. I'll talk about that more in just a second. LAZY, this is actually a pretty nice pivot being built here. You do have some overhead on the left side here, but it's setting up right into it. So if we can stay tight here and come out, that's a potential. SSTK, this is one that we tried to get involved in it over here, if you remember, and then it came in, uh, had a shakeout, stopped out, could have maybe bought it back on 1221. Since then, you're forming a nice little pivot here. So this is one that might be a failure reset. We'll keep an eye on that. And STAA is another one where, again, I think it needs to tighten up a bit more here. Some of these names we were we got knocked out of them, and they're still holding up, and we may get some type of reset. some of the ones that I think that we have to watch that I think should hold up here, and something like a PayPal. PayPal is, pulling back very orderly here. And again, this is one that we still have. We trimmed it out. We still have a piece of it, but I may add this back. These are stocks that maybe add on a pullback by coming off of natural reaction. But PayPal is one that I think should hold up. Something like a Penn Gaming, another one where this is pulling back pretty orderly. Bought it, sold it into strength, maybe buy it back on some type of pullback setup. Shops, another one where we still have open a piece of it, but sold it into strength, and now maybe buying it back on some type of pullback buy setup. These are some of the names. Zillow. I think these names should hold up. Most of these are not on buy alert. Well, actually, that's not true. Some of them are on buy alert. Yes, I'm sorry. Matter of fact, I think all of them are on buy alert, so that's wrong. But they're on buy alert basically for pullback buys here. Zillow's another one you can see came out, had a great breakout. Natural reaction right now. We'll only know if it's a natural reaction in hindsight if it gets into new high ground. Something like this MRSN, which I love. It's a big base. If you take a look here, I'll just zoom out. That's a large base. I love the right side being built. It came out, again, pulled back here. Did not move in enough to stop us. So still along the position. Would like to see a reversal recovery here. So that's another one we'll watch. Amazon, another one that, again, this came out pretty nicely here, pulling back. Let's see if it can hold and get into new high ground. Apple, of course, has been one that we had too tight of a stop on. Whoops. APL, let's bring that up. Yeah, if you remember, bought this coming up this right side right here, coming out right over here, and then pulled in, knocked us out on a little pullback, and then came ripping back on a gap, couldn't get back on it. So hopefully, hopefully Amazon will perk up, and like Apple, some of these FANG stocks, of course, have been it's been a bifurcated area of the market here. Let's see. So let's look at a few others. Something like a BCO. Now these are a little more questionable. That maybe pull back and the pullback buy coming back to the breakout. This is one I wanted to own. It came out on a gap. I did not chase it. It ran up. Now it's going to came all the way back, basically filled the gap. And now, I don't try to like to buy something that comes out and then comes all the way back in like that the next day. That's usually a sign of weakness. So we got to be careful here, but one that may be a pullback. Maybe pull back by DKL again, coming from this cheat area. This is getting to that oil area, and again, it's a lagging area, just starting to turn up on the 200-day FRTA. Real quick, I'll just go through a few of these names. Again, drifting back here, GSHD. Another name that again, we bought this here, coming up this right side, and now it's trying to hold up and build here. You had a few reversals. If it can tighten up and then get above that 130 area, that could be setting up for a buy. KRA, this is in the a chemical area, chemical company. So again, we're starting to see some of the cyclical kind of chemical, oil, if paper and steel start setting up, we'll really get into the area that I don't generally traffic in. But again, maybe if it tightens up here, you get a cheat area. MED is another one. We've been watching this for a while. RGEN, another one where you're trying to build this right side. We originally bought it right here, made a nice move, and now setting up another base. And then just a few more. RUN, trying to set up a right side there. SGMS, where you also you had a reversal here, and again trying to build this pivot here. So I think we're sort of where the again, I said this a number of times, where the rubber needs to meet the road. It meets the road, and then the car goes off the road each time. So it really we're waiting to see if we can gain some traction. And then this Unity software here, again, this is pulling all the way back here. It's still in a base, but it's been strong. So maybe you get some type of power play setup out of that. Other than that, I went over a number of names that we already have open long. Just sticking with, as you know, we have a lot of break-even stops now. So we've de-risked a lot of these trades that are at gains. Something like a CDAY, which is up, considerably from that breakout. It's pulled back normally. Another one, I would add this to that list of PayPal's and Pens, and so that really need to hold up. That these stocks that have been acting well, something like an LAD, which this was an incremental sell, still have a small position, got that shakeout right here, and maybe this stays tight and can get back out. It's still trying to build that right side there, so still relatively constructive. TME is another one where, I mean, you had a good opportunity to nail it down. It gapped on Thursday or whatever day this was. We had the day off. Was it Wednesday? And then we were up about 17, 18%. But it ended up coming all the way back down, closing on the low. But still, this is acting really good. So again, we already trimmed it out, and now we've got small positions in many of these. That's about it. I mean, let's see what happens. We're starting the new year, and sometimes it starts off with fireworks in one way or the other. I would, try to go easy here in the coming days, and see how things start the year, and then we'll let the stocks guide us. All right. Uh, Monitor the platform. Talk to you guys later. Bye bye.